In this video, I'm going to walk you through how to journalize business transactions. So utilizing the journal for a company and understanding the impact on our debits and our credits. So as you see here, we have our journal. Every journal is going to have a date column, the description column, which is where you're going to put your account names in. Post reference column, we're not going to utilize in this example. That is going to be dealing with when you go to actually doing postings to your general ledger. And then you have your debit and your credit. Notice your debit is on your left side, your credit is on the right, because debit means left, credit means right. As a reminder, debit and credit does not mean increase or decrease, because it's going to mean something different for each type of account that we deal with. And you'll notice that over here you have your accounting equation. That's not actually part of the journal, but it's just a way of showing you to see if your accounting equation kind of stays in balance and how it's impacting your accounting equation. You also have a chart of accounts, which you see over here. So these are the account names and the only account names that can be utilized in actually preparing your journal entries. As a reminder, a couple things with putting together your journals. Number one, any account that is being debited has to be listed first, followed by any account that is being credited. There has to be at least 2 accounts involved in every single journal entry that you have. There can be more than 2, but there has to be at least 2. And your debits and credits have to equal with every transaction that you record. So let's get started. It tells us on November 1st that Lexi, as one of our owners for our interior design business, has transferred cash from a personal bank account to an account to be used in the business in exchange for common stock. So again, we see 2 really important words here. We see cash and we see common stock. Notice over here, we have cash and we have common stock. So anytime you see an account name listed, we know that it has to be impacted in our transaction. So cash is what's coming into our business. When we receive cash, cash is going to increase, and we know that our assets have to increase with a debit. So we're going to debit our cash account for $50,000. And the reason why we're getting cash is that our owner has invested it into the business in exchange for ownership rights or equity rights in the business. So she's going to get common stock. Common stock, therefore, is going to increase as well. And we know that our equity transactions increase with credit. So you'll notice in that accounting equation, we see that our assets and our equity are both going up. Our accounting equation is staying in balance. My debits and credits are equal. The account that was debited is listed first, followed by the account that is credited. And you'll notice that any credited account is going to be that slightly indented because it's going to show that those are your credit transactions. Also on November 1st, it tells us that we've paid rent for the period of November 1st to the end of the month. So we know we pay everything in cash. We know our cash is going to be impacted. And what we're using our asset for is to pay for our rent for the period. So that is going to be an expense. So remember, your expense accounts are always increasing. We want them to always be increasing for our purposes now because we want to know by the end of the year how much in assets we actually used, in this case, for rent. So after November, we had used $4,000 in assets. After December, we had done $8,000 in assets. After January, it'll be up to $12,000. So we want to know by the end of the year how much did it really cost us to pay for our rent for that period. It's important for every business. Every business goes into business to make money. And one of the best ways to increase that is by reducing your expenses as much as possible. So if I see that I'm spending a lot on my rent, maybe I want to move locations. So for our period of time right now, we're going to have our expenses that are always increasing. They always increase with a debit. Cash is an asset to our business. We now have less of it. My assets increase with debits, which means they decrease with credits. On the 6th, they tell us that we've purchased equipment on account. There's our wonderful key phrase that we love, on account. So last word is account. First letter of the first word is P, which means we're dealing with accounts payable, which means I'm not paying for this piece of equipment today.
I'm going to pay for that equipment sometime in the future, but I still have it in my possession today. So equipment is an asset to us. So again, if you look over at your chart of accounts in your asset column, we have an equipment account, and I in total am buying $15,000 in equipment, but I haven't paid for it yet. So my asset account, we know, increases with a debit. So my equipment is going up, that asset account is going up, and my liability account increases with a credit. I owe $15,000 sometime in the future to somebody, so I have to show that as an increase to my liability account. And again, you see in that accounting equation, both my asset is going up and my liability is going up. On the 8th, it tells us that we've purchased a truck for $38,500, paying $5,000 in cash and giving a note payable for the remainder. Again, when you read that transaction, pay very close attention to the information that's being provided to you. It's guiding you. So what did we purchase? We purchased a truck. Well, we look over at our asset section, we see that we have a truck account. How are we paying for it? They tell us that we're paying $5,000 in cash. Well, we know we have our cash account, another asset account to us. And they said we're paying with a notes payable. So note payable is a liability. It's very similar to an accounts payable. It's just typically going to be for a longer period of time. So accounts payable, we might only have 30 or 45 days to pay that back. Note payable, I might be able to pay it back over a 5-year period, for example. So what am I gaining? I'm gaining a truck. My truck is an asset to me. I now have more of that asset, so we increase it with a debit. And then how am I paying for it? Well, I'm using some of my cash. I'm giving $5,000 in cash, so my cash is an asset. It decreases with a credit. And then I owe the rest on a note. So I owe another $33,500 sometime in the future for that remaining portion of that truck that I've purchased. So in this case, I'm affecting more than 2 accounts, which is perfectly fine. We know we have to do at least 2. My debited account is listed first, followed by this case 2 credited accounts. But notice that my debits and credits still equal. And if you're looking at the impact on the accounting equation, we see that my truck account increased my assets. My cash brought it down. So in net, that's a $33,500 increase to assets. And my liabilities went up by that same amount. On the 10th, it says we purchased supplies for cash. So supplies we know are an asset to us until we use them. So we recorded that as an increase to our asset. And we also have a decrease to a different asset, to our cash, because we are purchasing it with our cash. On the 12th, it says we received cash for job completed. So received cash, cash is coming into my business, my cash is an asset. We know we now have more of it. And every time we say we received cash, ask yourself the question why, because there's only one of 3 reasons why our business could receive cash. Number 1, that one of our stockholders has invested cash into our business in exchange for common stock. Number 2 is that we have received cash from our customers on account. They're paying off their accounts receivable. Or number 3, it's because we provided a service to our customer that day. So anytime you see provided a service, job completed, services rendered, that is telling you that today we went out, we provided a service to our customer and they gave us money today, meaning that we have earned it. So fees earned, revenue account for us, always increasing. Every time we provide a service, we've earned the right to assets. In this case, my customer paid me that day. So I charged my customer an $11,500 fee for my interior design business, and they paid me cash on that day. So remember, we always record our revenues when we have earned them, regardless of when we've actually received cash. On the 15th, it says we paid. We know we pay everything in cash. When we pay it, we have less of it. And we've paid, and this is important, we've paid an annual premium on property and casualty insurance. So annual, I've paid for the entire year. I've prepaid. And what have I prepaid? I've prepaid my insurance. So I have paid my insurance for the entire year in advance, and I've paid it with cash. So it's an asset to me because I basically own that insurance policy now. Somebody else, that insurance company, owes me some services over the next 12 months. So it's an asset to our business. On the 23rd, it says we recorded jobs completed on account and sent our invoices to our customers. So again, anytime you see jobs completed, services rendered, services provided, that means we've earned the $22,300, but it doesn't necessarily mean that we got it in our hands that day in the form of cash. So back on the 12th, it said we received cash. That day we provided the service, my customer handed me the money. On the 23rd instead, it says we provided it, and there's that key phrase, on account. So again, when we see the word account, but this time we're starting with an R instead of a P. So we've got accounts receivable. Accounts receivable is a holding place for cash. It's showing us how much we are going to receive in cash sometime in the future for something we've already done. So I've already provided the service to my customer. I just have to go back and wait to receive that money sometime in the future. But we always record our revenue when we've actually earned it. So think of it like your paycheck. So if you get paid every 2 weeks, every time you go into your job, you are earning the right to be paid. You're just not getting handed cash at the end of every day from your boss. You're waiting until 2 weeks. That's an accounts receivable for you. You're waiting to receive the money for something that you've already earned. On the 24th, it says we received an invoice for a truck expense to be paid on November. So it's going to be paid sometime in November. It's just not getting paid just yet. So it's a truck expense. Our expense is always increasing. We actually incurred that, but we haven't paid it yet. So it becomes an accounts payable for us because it's going to be paid. It just hasn't been paid yet. So it's something that we're going to do in the future. As a reminder, anytime we see something to be paid or on account, that's a purchase, that's automatically going to be accounts payable. The only time we ever use notes payable is if they tell us that it is in fact a notes payable. They then tell us we have a few more transactions, and we're going to record that on page 2 of our journal here. So it says on the 29th that we paid a utilities expense. We got our utilities expense for $4,500, and we paid it, so we know we pay everything in cash. Cash is an asset to us. It decreases with a credit. Also on the 29th, it tells us we paid a miscellaneous expense of $1,000. And again, we paid it, we pay it in our cash. On the 30th, it says we received cash. We can stop reading right there. We know we got cash. Cash is an asset to us, means our cash is going up. So we got our cash. Then we ask that really important question, why? Why are we receiving cash? So are we receiving cash because our owners have invested into the business, the stockholders, in exchange for common stock? Are we receiving it because we provided a service or completed a job that day? Or are we receiving our cash from our customers on account? And in this case, they tell us it's on account. So again, last word is account. First letter of the first word is R. I was waiting to receive the cash from our customers, and now I have finally received some of it. So remember, accounts receivable is a holding place for cash. I didn't provide the service to them on November 30th. I provided that service back here on November 23rd. I was waiting to receive the money, but I already earned it. And now I'm finally receiving some of it. So I'm swapping one asset for the other. So my receivable goes down. I'm not going to receive as much money in the future because I finally received it. And that's a good thing. That's what we want to have. Also on the 30th, it says we paid wages to our employees of $6,800. We know that our employees are an expense to us and our expenses are always increasing. On the 30th, it says we paid a creditor a portion of the amount owed for the equipment that was purchased on November 6th. So if you go back to November 6th, we bought that piece of equipment. It wasn't paid with a note. That was simply paid on account. So we're paying down some of that account payable. We're paying $3,000 worth towards that balance that we owe. So accounts payable is a liability to us. It increases with a credit, which means that it decreases with a debit. I don't owe as much money anymore. I owed $15,000. I just paid $3,000. So that's going to leave me a $12,000 balance. But I'm recording how much I'm reducing my liability by. And of course, we paid that creditor, so we know we pay everything in cash. And finally, we paid a dividend. So our dividends, just like our expenses, increase only and increase with a debit. And we paid it, so we pay everything in cash. So again, key things about your journal entries. Debited account is listed first, followed by credited accounts. Debits and credits always have to equal for every transaction, and every transaction has to impact at least 2 accounts.